All right, welcome. Today, we're diving into a classic debate that every single investor faces. Where do you put your money? Do you go with the giants, the established household names, or do you bet on the smaller, up-and-coming challengers? We're going to demystify the entire world of small cap and large cap stocks, breaking down what they are, the pros and cons of each, and, most importantly, how you can use them to build a stronger financial future. The best way to really wrap your head around this is with a simple picture. Imagine your portfolio is a fleet of ships. Are you going to build it around massive, powerful battleships? The ones that are steady, super reliable, and just dominate the seas. Or do you go for the nimble, lightning-fast speedboats? They're exciting, they're agile, and they just might outrun everybody. The real question is, does the best fleet maybe need a little bit of both? Let's find out. So here's how we're going to break it all down. First, we have to start with the single most important concept here. What even is market cap? Then we'll make the case for our battleships, the large caps. After that, we'll give the speedboats, the small caps, their turn in the spotlight. Then we'll put them side by side for a head-to-head comparison. And we'll wrap it all up by talking about how to strategically combine them to build a truly balanced portfolio. Okay, so let's dive right in. Before we can even begin to compare large companies and small companies, we've got to understand how the market sizes them up in the first place. And the answer to that is a little something called market capitalization, or market cap for short. Now, here's a really common mistake people make. They see a stock with a high share price, like hundreds of dollars, and think, wow, that must be a huge company. But that's not the whole story. The real measure of a company's size is its market cap. And the formula, it's actually pretty simple. You just take the price of one share and multiply it by all the shares that are out there. So a company with 50 million shares trading at $100 a pop has a market cap of $5 billion. That one number tells you what the entire market thinks that company is worth right here, right now. Okay, so now that we know what market cap is, how does the market actually use it to label these companies? Well, in the US, there are some generally accepted buckets. Large cap stocks are the real giants. We're talking companies valued at $10 billion or more. These are the household names you know and love. On the other end, you've got small cap stocks. These are the much smaller players, usually in that $300 million to $2 billion range. A lot of these are younger companies you might not have heard of, at least not yet. All right, so let's bring out our first contender. We are talking about the titans of industry. The established, heavyweight champions of the stock market, the large caps. And yep, these are our battleships. You'll often hear them called blue chip stocks. For a lot of investors, they form the stable core, the anchor of their entire portfolio. I mean, these companies have proven track records, they have dominant positions, and they're really built for one thing above all else, to be steady and resilient. So, what is it about these giants that's so attractive? Well, it starts with stability and lower risk. That's a huge one. These companies have weathered recessions, market crashes, you name it. Their stock prices tend to be way less volatile. Then there's the income. Since they're often mature businesses making huge profits, many of them pay out reliable dividends to their shareholders. Next up is liquidity, which just means it's super easy to buy or sell your shares. And you also have a ton of information available. Analysts and the media cover these companies 24/7, so there are usually fewer nasty surprises. Finally, think about companies like Microsoft or Coca-Cola. They make money all over the planet, giving you this amazing built-in global diversification. But, being a giant battleship isn't all smooth sailing. There are definitely trade-offs. Their greatest strength, their incredible size, is actually their biggest weakness when it comes to growth. It's something called the law of large numbers. I mean, think about it. It is way, way harder for a $2 trillion company to double in size than it is for a $1 billion company. The explosive growth phase is likely behind them. Their size also makes them less agile, slower to pivot, and a lot of them have already saturated their core markets, so there's just less room to expand. Okay, so that's the battleship. Now let's turn our attention to the challenger in the other corner. We're talking about the dynamic, high-octane companies that just might become the giants of tomorrow, the small caps. Exactly. If large caps are the stable battleships, small caps are the speedy, nimble speedboats. They are built for one thing, speed and growth. For many investors, this is the part of the portfolio that acts as the growth engine, the part that can really push your overall returns higher over the long run. And you can see right here why investors get so excited. The number one reason, of course, is that massive growth potential. A small company that really succeeds can multiply in value 10, 20, even 100 times over. They're also often prime takeover targets for larger companies, which can lead to a nice payday for shareholders. And here's something interesting. Because they fly under the radar of a lot of Wall Street analysts, you can sometimes find these undiscovered gems that the market hasn't fully appreciated yet. Plus, their small size lets them be incredibly innovative and agile, able to jump on new opportunities way faster than a corporate behemoth. Okay, but let's be really clear here. With high potential reward comes very high risk. This is the other side of the coin, and you absolutely have to understand it. The stock prices of small caps can be wildly volatile. We're talking huge swings up and down. And unlike the blue chips, these businesses face a very real risk of failure. If they go under, your investment could go to zero. Their stocks are also less liquid, so it might be harder to sell when you want to. And remember that lack of analyst coverage? Well, that also means there's just less public information out there, so you really have to do your own homework. So, there you have it. We've met our two contenders, the steady, powerful battleship and the fast, agile speedboat. Now it's time for the main event. Let's put them side by side, in the ring, for a direct comparison. This is the tale of the tape. And honestly, this quote just nails it. It perfectly captures the fundamental choice every investor has to make. What's your priority right now? Is it stability, preserving your capital and letting it compound steadily over time? Or is it growth, shooting for the highest possible returns, even if it means a bumpier ride? There's a place for both. This table really just lays it all out clear as day. I mean, look at the contrast right down the line. Risk level, low versus high. Growth potential, moderate and steady versus high and explosive. Dividend income, common and reliable versus pretty rare. It couldn't be clearer. Large caps are designed to be the core, the anchor of your portfolio, giving you that foundation of stability. Small caps are the satellites, the growth engine, designed to give you that extra kick. They are fundamentally different tools for different jobs. So after all that, you might be thinking, okay, so which one do I pick? And that's where things get really interesting, because the crucial point isn't about picking a winner. It's about building a winning fleet that can handle any kind of weather the market throws at you. So how do we do that? And right here, this is probably the single most important takeaway from our whole explainer. The savviest long-term investors don't try to choose one or the other. They understand that a truly resilient portfolio is built by combining the unique strengths of both. You get the steady, reliable power of the battleships working right alongside the explosive growth potential of the speedboats. Now, one of the most popular and effective ways to do this is a strategy called the core and satellite approach. And it's exactly what it sounds like. First, you build the big, stable core of your portfolio, let's say 70 or 80%, using simple, low-cost, large-cap funds, like an S&P 500 ETF. That's your anchor. Then, you add smaller, targeted satellite positions, the other 20 or 30%, using small-cap funds, like a Russell 2000 ETF, to add that growth engine. And this chart right here, it's a perfect picture of what that strategy looks like. You can see the big chunk, that 75% large cap core, providing the foundational stability for the whole portfolio. And then you have that important 25% slice dedicated to the small cap satellite, which is positioned to chase after that higher growth over the long haul. It's a really powerful and balanced combination. But of course, and this is so important to remember, this mix is not one size fits all. Your personal situation, especially your age and your time horizon, matters a ton. If you're in your 20s or 30s, you've got decades ahead of you, so you can generally afford to be more aggressive and have a higher allocation to small caps. As you get into your 40s and 50s, you might start to shift towards a more balanced mix. And then, once you're in your 60s and beyond, the focus naturally shifts from growth to preservation and income, which means leaning much more heavily on those stable, dividend-paying large caps. Phew, okay, that was a lot. We went from the basics of market cap all the way to portfolio strategy. So let's just pause for a second and boil it all down to the absolute most important points you need to walk away with. Let's run through them one last time. Number 1, large caps are your battleships. They provide stability and income. Number 2, small caps are your speedboats. They provide the potential for high growth. Number 3, the winning move isn't picking one, it's diversification. Using both is the key to a portfolio that can handle whatever comes its way. And finally, the most critical point of all, there is no magic formula. Your personal goals, your age, and your own comfort with risk are what will and should determine your ideal mix. So I'll leave you with this one final question to think about. Take a look at your own investments. Is your fleet of battleships and speedboats balanced in a way that makes sense for you? Is it built with enough stability to weather a storm, but also with enough agility to catch the wind when those amazing opportunities for growth appear? Thinking about that balance, that's really the first step toward building a powerful financial future.